Stock market investors, welcome back to the channel. My name is Jason. In today's video, we're going to break down a list of 33 stocks that are undervalued right now in a very volatile market. We're not going to go over all 33 because I found this article on Morningstar.com. I pay for it, so you guys don't have to. We're going to go through the list. I'm going to show you some of my favorite stocks from this list, break down the stocks, and find out which ones that are particular buys in this crazy market with all this nonsense going on in the Middle East right now. We got to be very careful right now. Here's the list. Take a look at your screen right now. But before we get into this, do me a huge favor. Hit the like button and subscribe to the channel. I'm giving you guys some information behind paywalls, so you got to subscribe to the channel now, guys. Let's get into it. All right, here's the list. From 1 down to 33. Some of the favorites on here: Walt Disney Group, Mosaic Company, Kohl's we're familiar with, General Mills, Energy Transfer, Elevance Health, Dow, Edison International, Comcast, Devon Energy, Clorox, Broadcom, Blackstone. So we're going to go through this list, and I'm going to pick out some of my favorite stocks from this list. I'm going to start out with a banger, and my favorite one from this list is Blackstone Inc. The stock has been getting destroyed over the last several months. It's been crazy. Year to date, stock is down nearly 30%. But I do like this website, Simply Wall Street. You get like 5 or so free ones a month where they go in and tell you some of the value here. Trading 4.3% below our estimated value. And this company also pays a dividend, that I really like. I'm a big fan of this company here in Blackstone. I think it's down big, almost 30% year to date. But over the last year, we've seen it down in the 120s all the way up here, closing in on $200, and then back down to where we're at right now, down $41 per share, around $112. So if we kind of break down some key metrics right now from the stock, the revenue just consistently going up and up and up over the last couple of years. So the EPS looks really solid as well over the last couple of years. From 2022 to 2025, we're seeing an increase in earnings per share. I'm a big fan of that. The assets are going up as well. Total liabilities going up a little bit for sure. The debt pretty much the same over the last 3 years. So they're able to handle the debt load, which I like. All right, guys, let's take a look at the valuation on Blackstone here. This is the 5-year average right here. This is the current where it is right now. So I love when stocks are trading below the averages. 5.89 below the 5-year average. You got to love that. Price to earnings below the 5-year average. I really want to buy Blackstone under $100 per share. If it gets down there, I'm going to start adding heavily. I did start nibbling a small position out. Price to cash flow. All these numbers are smaller than the 5-year average. The price to forward earnings right now is at 17. That's a really good bargain. PEG ratio at 1.39. This stock, in my opinion, is a screaming buy. I love Blackstone. Under $100, guys, we got to seriously consider adding this to our portfolio. The next one on this list I want to take a look at is Disney. Here it is, trading about 6% below estimated fair value. Earnings grew 118% over the past year, trading at good value compared to peers. Analysts in agreement that the stock will rise by about 33%. That's always good as well, right? We like 33%. All right, here we go. 4 stars on Morningstar. We'll just take a look at some of the key metrics right here. Price to earnings, 16.60. You got to love that. Price to sales at 1.82. Anything approaching 1 is a good number. The dividend yield in that solid range as well. Dividend trailing, the forward is at 1.5%. Right now, Fair value, $120 as well. We take a look at the chart here. Year to date, stock is down, closing in on 16%. I think under 90 bucks is a buy range in my opinion. So we'll take a look at the valuation real quick. Here we go. I do always like to look at the 5-year and compare it to where we're at now. The 5-year, I mean, Disney has been cheap for several years now. We haven't seen a huge run up in share price, right? So, and we got to remember with COVID and all that stuff, these numbers are a little bit skewed. So just take that into consideration right now. Price to book, 1.58. Price to forwards earnings at 14.5. The 5-year average at 21.4. I think it's a really good buy right now. I mean, the Disney, like I said, the PEG ratio has been around 1. And then over the last 5 years, under 1. So I definitely think Disney is undervalued right now. I could probably see the stock settling in the $150 range over the next several years. So I definitely think Disney could be a potential buy. All right, stock market investors, we're going to take a look at Broadcom Inc. right now, ticker symbol AVGO. They just announced an expanded deal with Google to develop and supply custom AI chips with Anthropic to provide computing capacity starting in 2027. So that's great. So some forward earnings going to look pretty good there for Broadcom. Price to earnings, 43.26. Price to sales, these kind of AI chip companies definitely trade at a premium. Fair value is projected around $500. The price right now, $314. The 1-star price, $775. 5-star price, $300. So anything under $300 could be a potential buy for us here. Very small dividend, but money's money, right? Take a look at the valuation from Broadcom right now, but before we do that, trading around 7.5% below estimated value. Earnings are forecasted to grow 30%. Earnings grew by 141% last year. They think the stock price analysts will go up by 50%. So another opportunity here for us to make some cash. Take a look at the current price to sales. We've seen an increase in price to sales. This company, over the last several years, has been trading at a premium price to sales wise because the earnings are going up exponentially. So when the earnings are consistently going up, stock tends to trade at a premium. 5-year PE is in the 40s. The current right now is in the 60s. Trading a little rich still, but PEG ratio is at 1.43. So that means earnings are great. Anything under 2, that means the company is growing well earnings-wise. Price to earnings growth ratio. We like that. We definitely like that. Current price to sales at 22. It's trading a little rich, but in this sector, it's pretty normal where this stock is kind of hanging out at right now. So I do like this company. If we take a look at the financials, we could see the growth over the last several years. Gross profit is up considerably. Like it's crazy. These numbers are in millions, but it's crazy. If we see from 2019 to 2025, it's crazy. This company is growing astronomically right now. And we always want to take a look at the balance sheet. The assets are growing as well. Total liabilities jumped up the last couple of years, but for several years it kind of stayed pat. So we'll have to keep an eye on this. It's going down. So we want to see the total liabilities tend to tick down for sure. Total equity is growing up. This company is maturing very well. Cash flow, always an important thing. Cash flow from operations, activities, indirect. The cash flow, we're seeing a steady increase in cash flow year after year. So overall, I think this company is a buy right now. I would like it under $300 per share. Next up on this list, stock we want to check out is GE Healthcare Technologies, Inc., common stock, GEHC. We'll take a look at the chart. Year to date, stock is down about 15%. Okay. Price to earnings at 15. Price to sales right where we like it in that one range. Fair value at $98. Price coming in around 70. 5-star price under 70 bucks at 68.60 is like where you really want to be jumping in right now. So this looks pretty decent so far. Now let's jump into this, go in a little more in depth and what's cooking here. So here we go. Current price to sales is a little cheaper than it's been trading at over the last several years. The 5-year is not available for this particular stock. Price to earnings, trading cheaper than it did in 25, 24, and 23. All right, guys, the PEG ratio is at 25. We got to see what's going on with the growth situation here. So we got to dive a little bit deeper into this company. I always like looking at the key metrics. Revenue growth percentage year over year. Not a huge grower, straight up. But the gross profits are growing considerably. So the company's being more profitable. The revenue growth isn't there, but the company is figuring out ways to become more profitable. That's something we like to see. Earnings per share, normalized EPS, the basic EPS, all these numbers look pretty good. They're not growing astronomically, so the growth is a little bit smaller with this company. We're not going to see huge growth with this company. So on this list, definitely a lower one on the totem pole. A couple more stocks here that I want to go over with you guys is Microsoft. I love Microsoft. I've been buying the crap out of Microsoft. Price to earnings is at 24. Price to sales is at 9. They pay a small dividend. But here, fair value is at 600. Price 372.88. 5-star price under $420. So this is in the buy range for price versus fair value here on Morningstar. Now let's take a look at some of the key metrics here for Microsoft. Revenue, this is a money-making machine, guys. The growth is great. It looks so good. I'm very impressed with this company. Gross profit ticking up. Profit margins are up. Operating margin percentages look great. They're just sustaining the gross profit margin over the last 5 years, half a decade, and increasing the operating margin percentage. I love it. Net income is just, look at the net income just going up huge. EPS, again, going up huge. This company is screaming buy, in my opinion. This is one of my favorite stocks in the entire stock market right now. I love it. And it's just getting beat up. The Magnificent Seven has just been getting crushed. Year to date, this stock is down 23%. It's a screaming buy, in my opinion. Take a look at the valuation here. At the 5-year comparison, price to sales, 5-year average. If we take a look at, I don't understand how this could be 4.30 and then all these numbers are significantly larger than that. That doesn't make a lot of sense to me, but I'll have to figure that out for you guys. Price to earnings, I love it. 23.33. It's been trading significantly lower than all of these numbers. It's really cheap right now, in my opinion. We take a look at the price to earnings right now, 23.33, 34 and 25, 34, 24, 36 and 23. Back in 2022, when the market kind of sold off a little bit, it was back in that buy range, and then it went back up. Seems like a good place to be buying to me. I love looking at those numbers. Price to sales, current at 9.11, but it's been trading cheaper than it has the last 3 years. and that's something I always look for when I'm evaluating a stock. Microsoft is one of my favorite companies, trading about 18% below estimated value here on Simply Wall Street. Analysts in good agreement the stock will rise 57.5%. I love that. Now here's an interesting stock, a dividend player, Energy Transfer. They're a company that moves all different types of energy from one location to another. And with the oil prices going up, they should seek a premium. Fair value at $22, trading in the $19 range. And it trades a really good dividend at 7%. I love that. Price to earnings at 15. If you could get this in the $18 range, I love buying dividend stocks and selling puts on dividend stocks because you get a cheaper price and then the dividend percentage goes up the lower the stock goes. So that's always something I'm looking for in my dividend stocks. It's like, can I get this cheaper? And if I do, I can get some premium along the way and starting to add to my position. Taking a look at the valuation. Here we go over the last 5 years. I mean, the price to sales is so cheap. Price to earnings is really cheap as well. Averaging about 10. It's at 15 right now, but if we take a look at the last couple of years, it is trading a little bit higher, but even at 15, it's still good value in my opinion. The PEG ratio under 1. This stock has been a buy for a long time in my opinion. I do love this company. 0.75 price to earnings growth ratio. I really like that, guys. So Energy Transfer, a good dividend player. And I want to look at Comcast. It has went up a little bit recently. Dividend yield closing in on around 5%, but it's sold off a little bit from its highs. It peaked I sold my position in the 30s, and now it's back to 27.79. So if we take a look over the last year, this is when you sell it. In the 30s, you sell covered calls, and if it gets called away, great. And then a buy range is in that under $25 per share. Then it rips to 30, you sell it again, and then rinse and repeat. If it gets down to $25 again, I will be a buyer of Comcast for sure. And then back to Energy Transfer real quick, 58.7% below estimated fair value for this company. So Comcast I'm looking at. Devon Energy is another stock that I'm looking at as well. Probably needs to go a little cheaper before I'm a buyer. I want to buy that more in the $45 range. Price to earnings at 12.69. I like to pay a small dividend. And energy stocks, especially right now, are never a bad thing. If we take a look at the valuation for this company real quick. Metrics look pretty good. Price to earnings trading under 12. Price to sales under 2. PEG ratio is a little bit higher than I would like. We got to see what's going on with the earnings growth for this company. Whenever you see a big jump up in the PEG ratio, you got to check and make sure the earnings are where you want them to be. Was it just a blip on the radar, or is it something more of a problem moving forward? So, all right, there it is, guys. I'm kind of wrapping up. This is the article, the 33 stocks I love. Blackstone, Broadcom is interesting. Comcast I really like as well in the $25 range. I think Energy Transfer and 18 is a really good buy as well. I'm not interested in General Mills or Kohl's. The growth is just not there for me. Microsoft is another company I love. There's tons of other companies on here. If you want to look at them yourself, break them down on your own. If you have any questions about them, I could give you my thoughts on them for sure. But I want to give you guys an overview of some of the stocks that I think are undervalued and where I'm potentially adding to positions. I'm adding to Blackstone and Microsoft pretty heavily right now. I think they're just really undervalued. And a solid dividend player is Comcast. I think in a volatile market, I think the bottom is probably in that $23, $24 range. I don't think we're going to go much lower than that, but I think it's a safer stock. Microsoft still probably have 10 to 15% downside. Same thing with Blackstone. These are my thoughts. Don't forget to like and subscribe.